Greetings. My name is Kyle Soley. I'm a partner here at Reed Smith, and with me is Yoni Fix. Yoni's a colleague, a lawyer here at Reed Smith as well. Reed Smith is a large international law firm, and we have one of the largest state tax practices in the country. We have 40 lawyers in offices around the country, practicing exclusively in the area of state tax. We have also one of the largest California practices in the country, with 8 lawyers dedicating a substantial portion of their time to California tax matters. And California is why we're here today, and in particular, why we're here today is California net operating losses. California, the Franchise Tax Board, the taxing agency that runs the income tax in California, has developed a number of policies that make it difficult for taxpayers to use their net operating losses like we think they should. Right. We're going to talk a little bit about that. So for example, the California Franchise Tax Board takes the position that net operating losses are not to be carried over by the group as a whole, but instead are to be divvied up among legal entities and then carried over by those legal entities, which causes taxpayers problems because if they don't have the right income in the right entity, they are not able to fully use their net operating losses. We're going to talk a little bit about that. We're going to talk about whether you can get another 6 years, as many as 6 years, on your California NOL carryover period. We're also going to talk about some interesting opportunity for taxpayers in the wake of mandatory single sales factor. Yeah. There's somewhat of a mismatch between the net operating loss that you developed back when there was 3-factor to what we have today with single sales factor. And we think that there's some solutions to those problems. So we're going to start today talking about the carryover of net operating losses by the group. Our view, and we're going to do a spoiler alert, our view is that the group should be able to carry over the net operating losses, not individual legal entities. It always works at the disadvantage of taxpayers to have their entities divvied up among the various members of the group and carried forward on that basis. Always to their disadvantage. So what taxpayers want to do is carry over those NOLs at a group level. And in our view, that is what the law provides. First of all, let's take a step back. The unitary business method. California is, well, it may not be the birthplace of the unitary business method. It certainly is where the unitary business method grew up. Unitary business, what does a unitary business mean? It means a unit. The whole thing is based on a unit, a single unit. You can take a unit and you can apportion it. The way the unitary business principle is supposed to work is you take all the operations of a business. Those operations are in different divisions, across different states, in different corporations. You take all of those operations and you treat them as a single unit. California has been the leader in taking all the operations across a group of affiliated entities and treating them as one single unit, one single member. So what do we have? We look at the statute, Yoni, we look at the statute. The statute reflects this. You have a tax that's imposed on net income, but when you go to compute the net income, what you do is you look at the gross income of the group and the deductions of the group. And one of the deductions that's allowed, I mean the deductions of course that are allowed are your ordinary business deductions. You have those allowed, you have interest deductions, but one of the deductions that's allowed is a deduction for net operating loss carryovers. In fact, the statutory section which authorizes and defines the taxable net income says that you're allowed deductions like ordinary business expenses and net operating losses. It has them in the same sort of definition or grouping of allowable deductions. And in fact, if you look at the NOL itself, when you go to compute your NOL, that NOL is computed on a group-wide basis. What California doesn't do, they don't look at separate line 28 separate taxable income. Okay? What California doesn't do is look at each individual corporate taxpayer to determine do you have income, do you have loss, and so on. What they do is they take the group's gross income and the group's deductions. And why does California do this? Well, it does it because the statute says it. California's statute, 24.416, says, well, we're going to look to federal law, Section 172 of the Internal Revenue Code, to determine what is a loss. Okay, what do we have to define our net operating loss. And you go to the Internal Revenue Code, and the Internal Revenue Code says, well, net operating loss is you take your gross income less your deductions. To the extent your deductions exceed your gross income, you have a net operating loss. So far, so good. And everybody agrees, the FTB agrees, that when you go to compute the net operating loss for California purposes, you take the group's income. Everybody in the group and the group's deductions, all those deductions. And if you have the excess of the group's deductions over the group's income, you have a group net operating loss. So it should seem simple. Here we're trying to teach, you're trying to treat this group as a single unit. Unitary tax principles tell you that. The statute, when you walk through the statute, it's consistent with that. So you say to yourselves, well, what's the problem? The problem is that the FTB promulgated a regulation. And why did they do that? Well, let's look at this at the apportionment statute. The FTB, we think, looks to the apportionment statutes to try to say, well, we have to divvy up the losses among the legal entities. And they would say, we've got to do that because our apportionment statute requires us to do that. And they look in particular at a provision in their apportionment statute that uses a singular article, the singular article, in section 25108 for corporations that have to apportion. They say, well, the corporation gets to deduct the net operating loss. That must mean a singular, and so therefore there's this elaborate regime then where they're divvying up the losses among legal entities because of that use of that single article in that apportionment provision. In our view, that is putting far too much weight on that statutory provision. You look at the apportionment provisions in California generally. Look at those apportionment provisions generally. There's often the use of the singular the. But that has been interpreted in all other contexts of apportionment as meaning the group. So for example, if you look at the apportionment provisions when you're computing your sales factor, your property factor, and so on, yes, there's a the taxpayer, a singular taxpayer, but the FTB and everybody agrees that must mean the group. In fact, the Franchise Tax Board has advocated for that. It advocated for that in Finnegan. It won the Finnegan case. We're back to Finnegan by statute. We've statutorily returned to Finnegan. That's the rule. But nonetheless, the FTB has concluded in its regulations that it is going to use an entity by entity, legal entity by entity approach for purposes of carrying over the net operating loss. And of course, as we discussed at the outset, this is all bad news for taxpayers. There's nothing good that comes for taxpayers out of using an entity by entity, because you always are going to run the risk that the wrong entity is going to get stuck with the losses. So if you look at the FTB regs, 25106.5, they divvy up the income, they divvy up the losses. That may be okay. They did that. There's some reasons you could do that. You may need, if a member is going to leave the group, how much of the loss goes with them, like you would have at the federal level. You divvy it up for that kind of purpose at the federal level. But what the FTB is, they go one step further. What they say is, not just for that purpose, but for purposes of carrying it over and deducting it, you're stuck with this entity by entity treatment. Even though we have the unitary group, even though we have statutory definitions that ought to allow for the computation and carry over the NOL at a group level, we're nonetheless going to divvy it up and force you to silo, and so that only that legal entity can deduct it. And we think, our view is that that is not consistent with a number of things. One, it's not consistent with the statute. We walk through technically how a net operating loss in California is computed. It's done at a group-wide basis. Why would you then carry it over on an entity-by-entity basis? Completely inconsistent with decades of the unitary business practice, decades of advocacy by the Franchise Tax Board saying you treat various corporate members of a unitary group as one unit. Inconsistent with that. Also inconsistent, I think, Yoni, you're going to walk us through an example that shows us this. You know, at its core, the net operating loss is supposed to create something like average income over multiple years. The Libson's Shops case from the United States Supreme Court from way back when told us that the whole point of net operating loss deduction is to smooth out income by creating something like average income over a series of years. Well, if you start siloing the NOLs into legal entities and they can't use them, you're defeating the purpose of creating that average income over multiple years. And again, in our view is, interstating may have its place, but really that place is in order to determine how much NOL follows a member when they leave the group.
Tracking.
For tracking purposes, for corporate transactions, that's why you would do it, which is sort of comparably why you would do it at the federal level.
Right.
So with that, I'm going to turn it over to Yoni. You have an example to walk us through to show us how this works.
So just as an example, let's take a simplified California combined group that's composed of two members. You have Corporation A, Corporation B. And for simplicity, we have only a 3-year period. Over this period, the group consistently has California apportionment percentage of 90%. However, in year 1, we have the group has a loss, right? Combined group loss, which has to calculate at the combined group level, of pre-apportionable income of 200. So as a result of California apportionment, it now has 180 of NOL carryover. Now, look to year 2 and 3. In year 2 and 3, again, same California apportionment. However, now the group is profitable. It's making it has $100 of taxable income in year 2, and then in year 3. After apportionment, we end up with $90 of apportioned California income in both years. Now, if you look over the span of the 3 years, it appears that the group does not have any economic
Breaking even.
loss. Yes.
Breaking even. Okay.
You would expect that.
So you'd expect no tax, right?
Right.
I mean, if you were applying Lipscomb shops, we're thinking average income is 0, no tax.
Right.
Is that the answer we get?
Well, under our proposed method,
Okay. All right.
which we think is proper under California law. So under our example, if you look at the bottom schedule, we can see what you would expect under the Unitary business principle and NOL policy of striking some sort of average income over a period longer than 1 year. So we have 180 of NOL carryover, California apportioned NOLs, and we are able to utilize them in year 2 and 3 to completely offset our income. So we end up with, as we can see highlighted in yellow, 0 of California apportioned income. Therefore, the group should not have any tax liability.
So when you apply the statutory method, the unitary business method, you get what you would expect to get, which is a company that earns no income over a course of 3 years, having no taxable income for California purposes.
Exactly. And which fairly reflects the group's combined income over these years. Now compare that to, the FTB's approach of intrastating. Again, using the same facts, right? You have 180 of California apportioned NOLs. However, under the intrastating method, you now have to divvy it up between the members based on their relative California apportionment. So in year 1, Corporation A, for example, if you look at the area circled in green, you could see of the 180 NOL carryover, because Corporation A has a 90% relative California apportionment, its contribution to the group's California apportionment, it gets 162 of the NOL carryover. Now, Corporation B only has 10% of the California relative apportionment, so it gets intrastated under the intrastating method, only 18 of the NOL carryover. That means that going forward, Corporation A has 162 of NOLs to use, but B is stuck with only 18. So now when we go to year 2, and for some reason now, either statutory, for example, move from 3-factor double-weighted sales to single sales factor.
Weighting changes.
Weighting changes, right? As a result, there's a change in the relative California apportionment. Each member's contribution to the group's California apportionment has changed. This could also be due to change in business inputs, like change in payroll, property, sales, etc. This now impacts how much each one of these members gets divvied, gets intrastated a portion of the group's income go forward. So in year 2, as you can see circled in blue, of the group's 90 of California apportioned income, Corporation A, instead of getting intrastated 90%, gets intrastated 50. So now it gets $45 of apportioned California income. Well, Corporation A is happy because it has NOLs, right? It can completely offset its income and has 0 taxable income for the year. Compare that to below Corporation B. Corporation B now, its relative California apportionment has increased from 10% to 50 and gets apportioned 50%, meaning $45 of California apportioned income. Unfortunately, it only has $18 of NOL carryover. Even though Corporation A, the combined group as a whole, has an additional 117 of NOLs sitting, they're trapped in Corporation A. So as a result, Corporation B now has to include in income $27 in taxable income. Same issue, now we're in year 3. Again, Corporation A gets apportioned 50% of the California apportioned income, 45, has enough NOLs, completely offsets its income. Again, Corporation B now has 0 NOLs, despite the fact that it has more than sufficient NOLs of the group sitting in Corporation A. So now it has to include the full 45 of California apportioned income that it was apportioned. So if you look at for example, the highlighted yellow cells where you see the red arrow, you see that the group over the period of the 3 years had to actually include in income $72. Even though, as you can see the cell below it, it had $72 of NOL carryover.
Because we established that it had no income overall. So it's going to report $72 of income to California, pay tax on that, even though the group's income over the 3 years is 0. Right.
And they might say, Kyle, well, this is just temporary, right? This is a temporary tax difference. Why are you so adamant that this is wrong, this is hurting taxpayers? Well, in our simple example, it's 3 years. So let's simplify. Instead of a 20-year carryover period, it's 2. So now the $72 of NOL carryover that we weren't able to use in years 2 and 3 expires. Now we've created a true permanent tax difference, tax impact on the combined group, and they have to pay, and they will never get an opportunity to now utilize those NOLs and create what the legislator intended, which is an average income over a period longer than 1 year by allowing taxpayers to have these NOL deductions.
So our view really is the taxpayers should take a look, see if they've got the situation, really see if they've got NOLs trapped in particular legal entities. And if they do, either take a return position that they are carrying over the NOLs on a group-wide basis, or file a refund claim, recomputing their NOL deduction, but computing it not on an entity-by-entity basis, but rather on a group-wide basis.
Yeah, you should be able to carry it on, yes, post-apportioned basis, but pre-interstating. The group should be able to utilize it, yeah.
Great. So the other thing we wanted to talk about, or the next thing at least we wanted to talk about, was the NOL carryover period. Right. So for a long time, California only had a 10-year carryover. And I think those are the NOLs. For the NOLs before 2008, there was only a 10-year carryover. And what we're going to be talking about is an opportunity to increase that carryover period for as many as 6 years. That's a big deal. If you only have one thing now, we have a 20-year carryover period, which is fairly generous, all things considered among the states. There's all these problems we're talking about, but that at least is fairly generous. But for back in the day, before 2008, when there was only a 10-year carryover period, adding 6 more years is a big deal. So before we get into exactly why that is, let's talk a little bit about basics of the net operating loss. It's important we go through a little bit of semantics here because we're going to rely on those semantics, those textual statutory semantics. We like to rely on the text of the statute. We like to rely on unitary business theory, FTB maybe in these areas not so much. But here, so we need to take a look at the statute. The statute says a net operating loss shall be allowed as a deduction in the year to which the loss is carried. Now, what's important there is that allowance of a deduction, and most taxpayers, even tax professionals, seasoned tax professionals, often don't think of this because they have no reason to. Right. But when you have a net operating loss carry over to a tax year, it's allowed as a deduction in that tax year, even if you already have a loss in that tax year.
Right.
It's important because for statutory interpretation reasons that you are allowed a deduction for a net operating loss even in a year in which you have a loss. So you've got a loss, let's say, in year 1 of 100 and a loss in year 2 of 100. You carry year 1 loss over to year 2. You still get to deduct it, even though you clearly don't need it in the sense of you don't need that tax benefit, but you're allowed the deduction. That statutory textual background is necessary to think about what happened when we had a suspension of the net operating loss deduction, a disallowance of that deduction in several years. So California in 2002 and 2003, and then again in 2008 through 2011, suspended the allowance of the net operating loss deduction. So we have the language is fairly clear. In these years, no net operating loss deduction shall be allowed. The legislature didn't want to make this a permanent thing. They just needed a little bit of money. So they didn't want to permanently disadvantage taxpayers. They said, look, in any year in which you have a net operating loss deduction that is disallowed, you get another year in your carryover period. So simply put, let's say you have a 2001 net operating loss. Well, that is carried over to 02 and 03, and it's carried over again to 8, 9, 10, and 11, okay? And it is disallowed in each one of those 6 years. You simply get, under the statutory text, 6 more years in your carryover period. It really is that simple. It's not magic. Makes sense, and the text of the statute supports it. So the issue that comes up, though, is that the FTB staff. Now, here a little bit different than the issue that we talked about with the NOL siloing, and it's fortunate. This does not yet, this does not yet have the support of a regulation. This is FTB staff wrote a legal ruling, and the legal ruling essentially said the only way you get that extension, the only way you get additional carryover years, is if in the suspension year you had income. In other words, you had to be able to use the NOL in a suspension year, and if you couldn't use the NOL, then you don't get additional years. Now, I've heard people say, well, that makes sense, because otherwise you have a windfall. Well, you wouldn't have been able to use it in that year anyway. Why should you get more time? Well, I tell you, that may be true from taxpayer to taxpayer, but in the aggregate, some taxpayers may have had income in the suspension year when they could have used it, but other taxpayers may have had income in an out year, and it just, in the aggregate, works to taxpayers' disadvantage to do that income testing to require the income. We actually had a professor from Penn, Michael NOL, testified, wrote an expert report for us in one of our cases. New Jersey did something similar, and he walked through that at the analysis, for why, in the aggregate, this kind of income testing approach that the California Franchise Tax Board staff has come up with works to taxpayers' disadvantage. It's not a windfall to simply extend the NOLs. In fact, it's the right policy choice. But setting aside the policy choice, okay, set all that aside, the text of the statute does not support what FTB staff is doing. The text of the statute is simple. You carry over the loss to a suspension year. It's disallowed because of the suspension. Right. You get another year for each of those suspension years. It's really that simple. So with that, sorry, go ahead, Joni.
So nowhere in the statute does it have income statement. The fact that you have to have income in the year. This test is solely from the notice.
That's right.
The legal ruling.
That's right. And so what we've done is we've prepared a schedule which sort of lays out year by year, loss year by loss year, really the affected loss years. What taxpayers should do is go back to their NOL schedules for the years 2000 to 2010. Those are the years you should look at, and see where you think the losses expired. The FTB is going to say those losses expired as many as 6 years earlier than we say. So we should look at those losses and use essentially the statutory method. We have on our table the Reed-Smith method, but it's really, you should read that as the statutory method. And you should use that method instead. And again, you've got 2017 returns you're going to be filing coming up. You can take a look at even 2001 to 2003 losses that you thought expired. Those may be available for you coming up on this 2017 return you're going to file later this year. So you should take a close look at that and see whether you can resuscitate some of those losses that you may have thought expired. Now, there's one more issue on losses we're going to talk about, right? It's apportionment and a switch to single sales factor that may be exciting for a lot of folks.
So, actually, it's kind of similar to the previous example where we're talking about what happens if there's a shift between, you would go from 3-factor double weighted to single sales factor. So we have an example to illustrate what happens if you have NOLs pre-shift to single sales factor. So in our example, we have a group, taxpayer has 3 years of losses, right? A total of 300 pre-apportioned losses. In the following 3 years, has, again, in total, 300 of income. Similar to a previous example, you look at the, here it's a 6-year period, not break even, right? No economic income. You wouldn't expect to have to pay taxes here. Now, especially if the factors, the inputs of the business stay the same, you would expect it to kind of even out.
I would be disappointed, if I ran a break-even business and somebody showed up with an income tax. I understand I got to pay the property tax.
At the end of the, on top of that,
other things, but I would be somewhat disappointed to pay an income tax and have a break-even business.
I would be too, yeah. So let's think about what happens when you take apportionment into consideration. So let's assume, the first 2010 through 2012 years, for simplicity's sake, let's assume the taxpayer did not make an election to file under single sales factor in 11 and 12. So using 3-factor double weighted sales, the taxpayer ends up with California apportionment percentage of 5%. So over the 3 years, the taxpayer ends up with $15 NOL carryover into the 13-year. However, despite the fact that there's no change in property payroll sales, now the factor is single sales factor, and this taxpayer's, out-of-state taxpayers, California apportionment percentage increases to 10.
Doubles.
Doubles, yeah. And now, as a result, has $30 of post-apportion California income pre-NOL deduction. Now, when he goes to use the NOLs, unfortunately, they're not enough to eliminate the California portion income, so the taxpayer ends up with $15 of California portion income that's taxable.
So all that really happened here, what really happened here is that you had lower apportionment in the loss years, right. And then once we switch to single sales factor, nothing changes but the business, but our apportionment doubles, which is a fairly common situation for taxpayers. Apportionment's doubling as a result of the sales factor. And as a result of that, in the income years, right, they're going to have twice as much income apportioned as they had losses apportioned, even though their income and losses may have been before apportionment the same in all years.
Right, and this could be serious impact for out-of-state taxpayers just as a result of this shift. So you have a clear mismatch, right? So what's the solution, right? Well, we think the solution, the less invasive solution, is to use single sales factor for those NOL years pre-statutory shift to single sales factor. And by doing so, as you can see in the example, now we have 30 of NOL carryovers, apportioned California losses that now can be used to completely offset the California portion income in the income years in 13 through 15, resulting in a result that we would expect over a period of time, consistent with NOL policy. We think this is consistent and also less intrusive than, for example, using 3-factor double-weighted sales in these statutory single sales years. And this is also...
Because you can go along, you at least don't have to confront the FTBs, or I should say, the initiative voters, policy in adopting single sales tax. Right. That's a topic for another conversation. Yeah. But just purely addressing the distortion that's inherent in the switch between your loss year and your income year, it's less invasive in the sense that you don't need to tackle those broader apportionment theory and policy issues.
Yeah, and we think that there's support for taking this position. For example, Tenneco West case in section 25-137, Tenneco West essentially says that you're allowed to, when you have this kind of mismatch as a result of change in the weighting of the apportionment factors, you're allowed to look to different tax years in order to change your apportionment and properly compute your tax in the current year. Combine that with Section 25.137 that says you're allowed to use alternative apportionment in any situation where the standard statutory apportionment formula does not fairly reflect your business activity in the state. So we think between those two, this is a cleaner solution for a clear mismatch that goes against the legislator's intent with allowing taxpayers to have NOL deductions to smooth out and have average income over a period of longer than 1 year.
And our example focused on, I think we did it for simplicity, that our loss years were 10 through 12. Some people may say, well, in 11 and 12, well, why wouldn't you have elected the single sales factor? You could have. And I think maybe that point would have a point, but I think in particular you look at those pre-11 years.
Yes,
when the taxpayer didn't have any option to do that. When they were stuck with a property payroll factor that were actually reducing the amount of NOL attributable to the state.
Right.
Those taxpayers are the ones, with those kind of losses that really ought to pay attention to this.
Yep.
Okay, well that brings us to the conclusion of our program. We hope that you found it interesting. We hope you take some of these issues back to your office and that they add value for your company. Thanks for joining us.